You tap your card on a terminal, the machine chirps, a green check appears, and the cashier hands you the coffee. It feels as though $5 moved from your bank to the cafe in 2 seconds. Sounds simple. It is not. What actually moved was a carefully formatted request through several companies, while the real money stayed exactly where it was. The scale is difficult to see from the checkout counter. In 2022, Americans made $153.3 billion general-purpose card payments worth $9.76 trillion. Visa alone processed 257.5 billion transactions on its networks in its 2025 financial year, while 4.9 billion Visa payment credentials were in circulation. That works out to hundreds of millions of messages on an ordinary day, before the lunchtime rush has even started. The system is expected to be available almost continuously. Visa describes a 6 nines target, 99.9999% availability, equivalent to less than 1 second of downtime per day. At the same time, a modern risk engine may examine more than 500 attributes before deciding whether one purchase looks normal. The customer experiences a beep. The infrastructure experiences a deadline. The first important piece of industry language is authorization. Authorization is not payment. It is the issuer's temporary promise that the transaction appears valid and that funds or credit are available. The word approved really means, based on what we know right now, we expect to honor this charge later. The later steps are called clearing and settlement. Clearing is when the merchant submits the final transaction details and the participants calculate who owes what. Settlement is when banks actually transfer money between themselves. A normal credit card purchase, therefore, has at least 2 lives. The first lasts roughly 2 seconds and produces the green check. The second continues later, before the merchant receives usable funds. Start with the card itself. A traditional card carries a primary account number, usually 15 or 16 digits. The first portion identifies the issuing institution and card program. The rest points toward the customer's account, with a final check digit designed to catch simple entry errors. The number is an address for the payment system. It is not the money. When the card is inserted, the EMV chip and terminal conduct a small cryptographic conversation. EMV originally stood for Europay, Mastercard, and Visa, although the technical standards are now managed by EMV Co. The chip uses cryptographic functions to create transaction data that is far harder to copy than the static information on an old magnetic stripe. A stolen recording from one chip purchase is not meant to become a reusable master key. A contactless tap does a similar job over near-field communication. The useful distance is normally only a few centimeters. The terminal energizes the card's antenna, exchanges payment data, and receives information needed for authorization. The radio step may take a fraction of a second. Most of the waiting happens after the card and terminal have already finished talking. A phone wallet adds another layer. The merchant often does not receive the card number printed on the plastic. It receives a payment token, a substitute credential connected to a particular device or merchant context. Visa announced its 10 billionth token in 2024. Tokens matter because a stolen token may be restricted in ways a raw card number is not. The system can replace the token without replacing the underlying account. Now the terminal builds an authorization request. The request includes the purchase amount, currency, time, merchant identity, terminal information, and a 4-digit merchant category code. A grocery store, airline, hotel, and gambling business do not look identical to a bank. The merchant category helps determine risk rules, rewards, restrictions, and sometimes the fee structure. The terminal normally does not speak directly to Visa, Mastercard, or the customer's bank. It speaks to a payment processor or gateway. The gateway is the merchant's secure doorway into the payment system. For an online purchase, it also translates information from the checkout page, handles encryption, and may run its own fraud filters before sending anything farther. Behind the gateway sits the merchant's acquiring bank, usually shortened to acquirer. The acquirer is the financial institution responsible for bringing the merchant into the card network. It underwrites the merchant, connects transactions to the network, receives settlement funds, and takes responsibility for certain losses if the merchant disappears or behaves badly. The cafe may think it has one card reader. Legally and financially, it has joined a supervised chain. The acquirer or its processor sends the authorization request into the card network. The network is the switchboard. It recognizes the account range, identifies the issuing bank, applies network rules, and routes the message to the correct destination. Visa describes its network as connecting acquirers and issuers, so a request can be authorized, cleared, and settled through a common system. This is the point where an important misconception falls apart. Visa usually did not give you the credit card. Mastercard usually did not lend you the money. The issuing bank did. The network provides the rails, rules, routing, and security services. The issuer owns the customer relationship, sets the credit limit, sends the bill, and ultimately decides whether the purchase is approved. The issuer receives the request and begins a race against the terminal's patience. It checks whether the account is open, whether the card has been reported stolen, whether sufficient credit remains, and whether the transaction violates a control. A corporate card may block entertainment spending. A debit account may lack funds. A card used in 2 countries within 20 minutes may attract attention for reasons involving geography and commercial aviation. Then comes fraud scoring. The system can compare the purchase with the customer's history, device information, merchant, time of day, location, amount, recent declines, and hundreds of other signals. Visa says its advanced authorization service can evaluate more than 500 risk attributes per transaction. The issuer combines signals from the network with its own data, then makes one of several decisions: approve, decline, request more authentication, or rely on a backup rule. A clean approval creates an authorization code and usually places a hold on the customer's available credit. On a $100 credit limit with $60 already used, a $20 approval may reduce the remaining available credit from $40 to $20. The account balance has not yet been finally posted. The bank has simply reserved capacity so the same credit is not promised twice. The approval message now travels backward. Issuer to network, network to acquirer or processor, processor to terminal, terminal to cashier. Each participant adds only a small amount of time, but the entire chain must finish quickly enough that a customer does not remove the card, tap again, or assume the machine has frozen. The merchant receives a response code, not a sack of digital cash. Approved tells the merchant that the issuer intends to pay under the network's rules. Declined may mean insufficient funds, suspected fraud, an expired card, a technical failure, or a broad instruction to contact the issuer. Merchants are deliberately given limited detail because a checkout screen should not become a diagnostic tool for criminals. For the customer, the transaction is finished. For the merchant, it has barely begun. At the end of the day, or in repeated batches during the day, the merchant submits completed transactions for clearing. This submission is sometimes called a presentment. The final amount may differ from the authorization. A restaurant can add a tip. A hotel can settle after checkout. A fuel pump may first authorize a temporary amount because it does not yet know how many gallons the customer will buy. During clearing, the network validates records, applies rules, calculates fees, and determines net obligations. Imagine Bank A issued cards that spent $10 million at merchants acquired by Bank B, while Bank B's cardholders spent $8 million at Bank A's merchants. The system does not need to move $18 million in both directions. It can net the positions and settle the difference, subject to the network's detailed procedures. Settlement is the banking step. Funds move between financial institutions through designated settlement arrangements. The acquiring side credits the merchant, minus fees and any reserves. The timing varies by provider, geography, risk, weekends, and contract. The 2-second approval was a promise. Settlement is the accounting that makes the promise real. The fee structure is another chain, not one mysterious swipe fee. A small U.S. online merchant using a flat-rate provider may see a public price such as 2.9% plus 30 cents for a successful domestic card payment. On a $100 sale, that is $3.20. The merchant receives $96.80 before paying for the product, staff, rent, shipping, returns, and taxes. Inside that $3.20 are several economic layers. The largest is often interchange, paid through the acquiring side to the issuing bank. Interchange compensates the issuer for operating the card program, funding rewards, taking fraud risk, and, with credit cards, extending credit. The exact rate depends on card type, merchant category, transaction method, region, rewards, and whether the required security information was supplied. Debit illustrates how specific the rules can become. For large U.S. issuers covered by Regulation 2, The maximum interchange amount is generally 21 cents plus 0.05% of the transaction value, with a possible 1 cent fraud prevention adjustment. On a $100 covered debit purchase, that formula reaches 27 cents. Credit card interchange is not governed by that same cap and can be much higher. A second layer is the network fee. Visa or Mastercard charges participating financial institutions for services such as processing, authorization, assessment, cross-border handling, and data products. The network slice on one ordinary purchase can look small. Multiplied across extraordinary volume, it becomes a substantial business. Visa reported $40 billion in net revenue for fiscal 2025 on $14.2 trillion in payments volume. A third layer belongs to the acquirer, processor, gateway, and merchant service provider. Sometimes these are separate companies. Sometimes one company performs several roles and presents the merchant with one blended price. The markup pays for terminals, software, support, compliance, fraud tools, underwriting, and the risk that a merchant fails after accepting payments. The issuing bank may have an even larger opportunity beyond the transaction fee. It can earn interest when customers carry balances, annual fees on premium products, and interchange whenever the card is used. Rewards are not free money produced by a cheerful computer. Miles, points, and cashback are financed from the economics of lending, fees, interchange, merchant prices, and customers who do not always pay in full. The process sounds elegant when every message behaves. The daily reality is maintenance, exceptions, and fraud. Terminals lose connectivity. Gateways time out. Merchants accidentally submit the same transaction twice. Tips fail to match authorizations. Rental companies discover damage days later. Customers forget purchases and file disputes. Criminals test stolen card numbers with tiny transactions, then move quickly when one succeeds. The network must distinguish a tourist buying a watch from a fraudster buying the same watch, using almost the same data. False declines are expensive too. A bank can stop fraud by declining everything, just as an airport can eliminate lost luggage by banning luggage. The useful system must approve legitimate purchases while rejecting illegitimate ones. Visa says tokenized transactions can produce roughly a 35% reduction in e-commerce fraud compared with non-tokenized transactions and nearly a 5 percentage point increase in authorization rates. Security and sales are being optimized at the same time. Disputes continue long after checkout. The cardholder can challenge a transaction, the issuer can raise a chargeback, the merchant can submit evidence, and the network can apply detailed reason codes and deadlines. Visa said it processed 106 million disputes globally in 2025, 35% more than in 2019. Every one represents a payment that had supposedly ended when the terminal printed approved. Fraud losses are spread unevenly. Federal Reserve data for covered U.S. debit issuers found total fraud losses of $17.63 per $10,000 of transaction value in 2023. Merchants absorbed 49.9% of those losses. Issuers absorbed 28.3%, and cardholders absorbed 21.8%. The authorization, clearing, and settlement cost at covered issuers averaged only 4.1 cents per transaction, but the surrounding risk can be far larger than the computing cost. Then there is compliance. Merchants and service providers must protect account data, rotate keys, patch terminals, monitor access, retain logs, and follow security standards. Networks maintain lists of compromised credentials and suspicious merchants. Banks screen for sanctions and money laundering. The checkout may take 2 seconds, but the evidence may need to survive for months. Visa's risk system can examine more than 500 attributes before a single green check appears. The structural weak point is not one particular company. It is the requirement for coordinated, real-time trust. A card transaction depends on several independent systems agreeing before the customer walks away. The terminal must trust the merchant software. The acquirer must trust the merchant. The network must route correctly. The issuer must recognize the account and return a decision. If one link cannot answer, the others do not possess enough information to complete the purchase safely. This failure does not remain contained. A slow issuer creates timeouts at processors. Timeouts encourage terminals and customers to retry. Retries create duplicate messages and larger queues. Larger queues slow the system further. Merchants may switch to offline acceptance, but then they take the risk that the account is stolen, closed, or over its limit. Networks can use stand-in processing. where predefined rules approve some transactions when an issuer is unavailable, but no backup can safely approve every amount for every card. The cascade became visible across Europe on Friday, June 1st, 2018. At 2:35 in the afternoon, Visa's UK operations team detected a partial degradation in the Visa Europe authorization system. The system had two redundant data centers, and each data center had a primary switch and a backup switch. On paper, this was the sort of design built to survive a hardware problem. The turning point was that the switch did not fail cleanly. A component in the primary data center suffered a rare partial failure. That prevented the backup switch from activating normally. The malfunctioning system kept trying to synchronize messages with the secondary site, creating a backlog there and slowing the backup site's ability to process new transactions. Redundancy existed. The failing component interfered with the redundancy. For shoppers, the architecture translated into declined cards and confused checkout lines. Some merchants could not accept card payments. Banks and businesses advised customers to try cash or another card. The network was never completely offline, but the disruption lasted from 2:35 p.m. until 12:45 a.m. Visa said the impact was largely resolved by 8:15 p.m., after teams disabled applications at the primary site and cleared message backlogs at the secondary site. A later UK parliamentary briefing said the incident affected 1.7 million cardholder accounts and caused 2.4 million transactions to fail. The original problem was one partially failed switch. The visible result was millions of people discovering that a plastic card is only useful when a chain of distant computers can agree fast enough. Visa later migrated its European processing onto its global VisaNet system and decommissioned the older European platform. The new architecture used multiple active systems and fallback routes intended to isolate a partial failure more quickly. The ending was not replace the broken box. It redesigned the system so the next broken box could not create the same queue. The larger industry trend is moving the sensitive account number out of ordinary commerce. A token can be limited to one phone, one merchant, or one use pattern. If a streaming service suffers a data breach, the token stored there can be replaced without canceling the customer's physical card. If a phone is lost, its device token can be suspended while the underlying account remains active. Visa's milestone of more than 10 billion issued tokens shows that tokenization is no longer an experimental feature. It is becoming the normal identity layer for digital cards. This changes authorization itself. A token can carry richer context about the device and transaction. The issuer may know that the credential came from a phone previously unlocked with a fingerprint, rather than from 16 digits typed into an unfamiliar website. Better context can reduce fraud and false declines together. Visa reports that tokenized e-commerce transactions have shown about 35% lower fraud and nearly 5 percentage points higher authorization than transactions using traditional card numbers. At the same time, card networks are being challenged by account-to-account payments, instant bank transfers, digital wallets, buy now, pay later providers, and stablecoin-based settlement. The surface experience may still be one tap. Underneath, the industry is competing over which ledger moves, which identity is trusted, and which company controls the customer relationship. The difference between a good transaction and a bad one can be measured on a single $100 sale. In the good scenario, the customer uses a tokenized credential at a legitimate merchant. The first authorization succeeds. A flat-rate online processor charges $3.20, leaving $96.80 for the merchant. The issuer sees strong device and history signals. The customer receives the product. The transaction clears once, settles normally, and never appears in a dispute queue. In the bad scenario, the first request times out after 2 seconds. The customer taps again. Both requests eventually arrive, creating two $100 authorizations. One is reversed, but the temporary hold remains visible. Or worse, the first approval is fraudulent. The merchant ships $100 of goods, loses the sale through a chargeback, and may also pay a dispute fee under its processor's contract. Revenue can move from positive $96.80 to negative product cost in one reversal. Even legitimate declines create a thin margin. A tokenized flow that improves authorization by nearly 5 percentage points can mean roughly 5 additional approvals for every 100 comparable attempts. For a merchant processing $1,100,000 attempts, 5 percentage points represents up to $5 million of potential sales difference before costs. A tiny change in a bank's risk threshold can look trivial in software and enormous in a quarterly report. So why do companies remain in a business where the visible transaction may earn only cents? Because the 2-second decision controls much more than the fee on that purchase. The issuing bank gains a place at the center of the customer's spending. It can earn interest, annual fees, interchange, and loyalty. It sees recurring merchants, travel patterns, spending categories, and whether the customer is likely to move to another financial product. The network gains something different: global coordination. Visa and Mastercard do not need to manufacture every card or lend every dollar. They operate common rules that allow billions of credentials to work across millions of merchants and thousands of financial institutions. Visa's $40 billion of 2025 net revenue came from sitting at that coordination layer, where a small charge can be repeated across 257.5 billion processed transactions. Processors and payment platforms stay because the transaction is the doorway to software. Once a merchant depends on a provider for checkout, that provider can also sell subscriptions, fraud screening, invoicing, payroll, lending, analytics, tax tools, and foreign exchange services. The card fee may open the relationship. The surrounding operating system makes the relationship valuable, and every participant values control. The issuer wants control over credit and fraud. The network wants control over standards and routing. The processor wants control over the merchant interface. The wallet wants control over the credential the customer reaches for first. The 2-second payment is a contest over who becomes invisible enough to be trusted.